and welcome to the Global View. I'm Andrew Gagan. Good to have you with us here at ausbiz on this Friday, the end of a very tumultuous week. The focus for global markets remains on the United States as investors consider another Trump presidency and the Federal Reserve's decision to cut its funds rate by another 25 basis points.
We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%.
So with expectations that President-elect Donald Trump's policies will be inflationary when he assumes control of the economy in January, Fed Chair Jerome Powell says the election result has not altered the FOMC's policy stance.
In the near term, the election will have no effects on our policy decisions. As you know, many things affect the economy, and anyone who writes down forecasts in their job will tell you that the economy is quite difficult to forecast looking out past the very near term. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume.
And as for the Fed's policy outlook,
we're on a path to a more neutral stance, and that's very much what we're on. That has not changed at all since September.
Meanwhile, the Fed Reserve Chairman has said he would not step down from his position, even if asked by President-elect Donald Trump, pointing out that the president doesn't have the power to fire him. Well, the election of Donald Trump has continued to buoy global equity markets. Stocks on Wall Street extending their recent records following the Fed's widely expected decision to cut its funding rate by 0.25 percentage point. Investors are now watching if the Republicans will win control of both houses of Congress, making it easier for Trump's policy agenda to proceed. However, the Trump trade unwound across the session, with shares of Trump Media and Technology Group tumbling, having surged around 200% in the 6 weeks leading up to the election, as the stock became a proxy for Trump's re-election chances. Shares of US banks fell, with the larger banks likely to see a lesser impact from the deregulation expected under a Trump administration than the regional lenders. However, shares of the Mag 7 have continued to rally, with Tesla adding to its surge off the back of the Trump win. And shares of oilfield services firm Halliburton that fell after it saw its revenue decline after oil and gas companies rallied in the previous session on expectations of Trump's energy-friendly policies. Warner Brothers Discovery shares rose after posting a surprise third quarter profit helped by robust streaming subscriber growth. And shares of ride-hail platform Lyft jumped after seeing its revenue surge more than 30% in the third quarter. And US-listed shares of both Rio and BHP rising strongly in that session on Wall Street. Well, US Treasury yields have stayed lower across the board, but trimmed losses after the Fed's rate cut amid further data showing a cooling labour market. The US 10-year yield was down 7 basis points at 4.35%, the 2-year falling to 4.22%. And the US dollar slightly pairing losses there after the Fed decision, with the Aussie at 65.8. In fact, meanwhile, the British pound, I should say, rallying sharply after the Bank of England cut its key lending rate by 0.25 point to 4.75%, but indicated future cuts may be more gradual than expected. And Sweden's central bank also cutting 25 basis points, while Norway left rates on hold. Taking a look at commodities overnight, oil prices have risen as the market considers how President-elect Donald Trump's policies would affect supplies, while production in the Gulf of Mexico has been cut ahead of a hurricane. Brent crude futures up 1% at $75 a barrel. Metals have rallied, copper up more than 4%, while iron ore has risen more than 1% to $106 a tonne, and the gold price rebounding following the Fed's rate cut to be up more than 1.5% to $2,704 an ounce. And Bitcoin maintaining its strength, up around $75,500. Well, to get a cross reaction to obviously the Fed decision this morning, our time, plus of course the impact of the election of Donald Trump, I caught up earlier with the Chief Investment Officer of Multi-Asset Investments, Anwita Bahugana.
I think that's an excellent question, and that was a question that actually Chair Powell also got today and answered in his press conference that There was a lot that was discussed during the campaign by the president-elect on several fronts, on fiscal policy, on immigration, on tariffs. But we don't yet know the scope of any of those policies and the timing of any of those policies yet, Andrew. So yes, a lot of that could potentially in 2025 affect the stance of monetary policy. But for the moment, I think it's very much responding to the current macroeconomic environment.
All right, so how do we see that current macro environment, and particularly what's the Fed's interpretation?
Right. So I think if we look at the macroeconomics right now in the US, you can see that there is some softness in labor market, but not too worrisome for the Fed to have any sort of recessionary fears on the forefront. It's really normalization of labor market data. At the same time, inflation's progressing slowly towards their target mandate of 2%. So it's what we have been calling internally, Andrew, a soft landing scenario where growth slows down towards trend or slightly below trend and inflation comes down. And that's an environment where current monetary policy is restrictive. And so the Fed is on its way to cut interest rates, having already done 75 basis points as of this afternoon in the US. They are on track to potentially cut another 25 basis points in December. And hopefully in early part of 2025, there'll be more clarity on fiscal policy and other policies that they can then begin to incorporate into their assessment.
So let's then focus on the election of Donald Trump. And of course, in the lead up to that, we saw markets take that bet that he would win. Bond yields having surged considerably, they remain elevated. What do you make of that?
Yeah, that's something we're watching very closely because that would be a very good indicator of whether bond market's getting worried about inflation. So as you mentioned, we saw sharp rally today, but yesterday bond yields rose quite significantly, and they had been going up, Andrew, for almost a month before that. And that entire increase of about 50 to 60 basis points, we broke that into what may be causing that increase. And our assessment is that maybe 2/3 of that increase or most of that increase is really increase in term premium and general uncertainty, but also better growth fundamentals in the US. And then maybe 1/3 of it is because of higher inflation expectations. So that's something to watch as policy decisions become clear to us on whether bond market's worried about inflation or not.
Well, certainly a perception that Donald Trump's policies will be inflationary, particularly as he adds to the US government debt position. How do you weigh that up with the outlook for equities, given he's put forward those policies of lower regulation, lower taxes?
Right. So the two set of policies we're focusing on here is, as you saw, the relief rally we saw in markets the last few days. That's been pretty much an anticipation of less regulation in the US for corporations, and also potentially extension of the tax cuts, which are currently enacted in the US, which are set to expire next year, but extension of those tax cuts, which is, from a fiscal point of view, stimulative for the economy. And that, Andrew, is good for stock markets, and especially the small cap stocks, responded very strongly to that potential for regulatory relief. On the other hand, the policies on immigration, stricter enforcement of immigration policies, potentially tariffs, and potentially trade barriers are things that affect the supply side of the economy and are actually inflationary and not necessarily good for the stock market. So very important to see how these play out in the future.
So, and Woody, what's your positioning at the moment as far as you're waiting with equities and bonds?
So, excellent question. At the moment, we are staying with the overweight position in equities over bonds. We have a moderate overweight in the US, and we have a small overweight internationally in emerging markets, and we are neutral developed markets ex-US.
Well, speaking of emerging markets with a focus on Asia and in particular China, once again, if we consider the policy effects of Donald Trump, if he follows through, obviously, with those threats of significant tariffs, how do you see that impacting China?
Yes, and that's a big if there, Andrew. I think that would be definitely a negative impulse for Chinese equities. At the moment, though, what we have been noticing is that economic surprises in China have been improving. And at the same time, there is enormous emphasis on stimulus within China itself. So Chinese domestic policies have been focused on monetary stimulus, fiscal stimulus, support for the property markets, all of which are really supportive of Chinese equities. But you're very right, there is that threat of potentially very strict tariffs on Chinese imports.
And of course, we are expecting more stimulus from China. Do you think perhaps they have been waiting for that election outcome and then will respond appropriately?
That is quite a possibility because they've been hearing this rhetoric all year of potentially more restrictive tariffs. So I think they have been probably waiting to hear what exactly is laid out. So yes, that is quite a possible scenario.
All right. So more broadly with emerging markets, well, you're fairly cautious then, are you?
I would say so till we know more about it.
All right. Well, that's the thing, isn't it? It is uncertainty. So at what point do you actually make those changes to a portfolio? Do you need to wait until Trump assumes office and he actually sets down some significant policy detail? But of course, we look at his past presidency, he doesn't always follow through with those threats.
I would certainly say that one thing I'm certain of is that uncertainty is going up. And very much to your point, we are not sure exactly whether the campaign rhetoric translates into policy, what sort of legislations actually put forward, and exactly what sort of legislation gets passed. And I think one thing I want to emphasize as someone who follows economics very closely, sometimes we are not exactly sure of the impact of the policy on the macroeconomy, because other than trade policies, there can be other things that are happening domestically in these countries which could have an impact on their market. So there's a lot to think through. We will be watching who he appoints as his advisors. What are the statements they make? What do they put forward? A lot to sift through. But for the moment, we are very much focused on fundamentals. And fundamentals generally look good domestically as well as are improving internationally.
And Woody, thanks so much for joining us from Multi-Asset Investments. That is Woody Bahahuna from Multi-Asset Investments, the Chief Investment Officer. Okay, so let's check where we're likely to get going. A very positive start indicated there by SPI futures up 1.2%. Stay with us because the open is just a minute away.